Everyone wants passive income, but almost nobody actually has it because most of what gets labeled as passive is just a second job with better branding. Rental properties, Airbnbs, day trading, they all look passive on a spreadsheet, but none of those are actually passive on your calendar. They all require sweat, tears, effort to get that income to come in. Now, I'm not saying this as a theorist. I actually own a lot of real estate directly. I've managed operators. I've watched investors burn out and try to manage this so-called passive income because of these constant decisions, stress, and emergency phone calls. And so here's the litmus test that most people miss. If your income stops when your attention stops, it is not passive. True passive income has three traits: no daily decisions, no operational leverage on your time, and no dependency on being on. If you're the system, you don't own an asset, you own a job. And so in this video, we're going to go over 6 truly passive investments that can generate income that's going to your bank account without your effort, time, or attention. Now, my name is Brad Johnson, and I'm the managing partner of Evergreen Capital, and we specialize on alternative investments for high net worth individuals. So today I'm going to show you the private investments that we typically recommend to our clients, and we're going to break down the ranges and the type of income and yields those investments typically offer. All right, so here are 4 investments that a lot of people on the internet will advertise as passive, but couldn't be further from the truth. Rental properties. You're making the investment, you have to take care of the building and the tenants, and guess what? The tenants call a lot. Things break, the property needs a lot of maintenance, and it's going to take a lot of stress, and it's going to eat up a lot of your time and capital. Great opportunities to make money in real estate, but it is the furthest thing from passive. Short-term rentals, this is like an Airbnb. These are even worse from a passive standpoint because they're hotels effectively. You have people who are on vacation, they're spending a lot of money, they have very high expectations on that property. Next up, active trading. There's this idea that you could just sit at your desk and watch the stock market from your computer and make a lot of passive income from buying and selling stocks. Well, the people that teach this, why in the world would they be teaching it if they could generate hundreds of millions of dollars on their own? This is far from passive in that it requires your constant attention and the stress involved with making those buy and sell decisions each day, and has been proven time and time again that it's not an effective way to generate actual profits. Business ownership. This is even worse than real estate because businesses are applying services and products to customers with high demands. You would be managing employees. Even if you are hiring somebody to take over the asset, you still have to supervise them. All right, so those are the 4 that are far from passive. What is actually passive? All right, so we're going to tick through these quickly to give you a little more context on the type of returns, the type of actual income that you can see from these investments. Real estate debt, once mortgages, a lot of people watching probably have a mortgage. So the 20% down and the 80% you need to go ahead and finish that purchase comes from the bank. Well, in this case, you are the bank. You are making a loan to either the purchase of that real estate property, the home, maybe it's a retail asset, maybe it's an industrial building, hotels, manufactured housing. You can do a ton of stuff, and you can do this in a diversified way and just collect the interest payments. This is a great way to get fairly steady income on a monthly basis. And so the range here on yields is anywhere from 8 to 12% typically based on where today's interest rates are. Monthly distributions are possible because the frequency of debt payments it tends to be monthly. And because it's debt, not equity, of course, it has lower volatility. It has lower risk. So the valuation of those loans is not going to move around as much. Real estate equity tends to have smaller yields, but higher total return profile. So key characteristics over here, we have 3 to 7 cash on cash. That is a monthly or quarterly type of yield on the amount of money that you put in. So in this case, if you put up 100,000, you would be getting $3,000 to $7,000 a year in those cash on cash yields. And you have the potential to get much higher total returns because as you increase the risk of an asset, you should also increase the total return profile. GP stakes. This is a unique asset class where you are investing in the private equity firms themselves. So the Blackstones of the world, the Carlyles, the KKRs, the Apollos, Ares, those are all publicly traded private equity firms. You can actually do this in the private market as well with middle market firms and a lot of firms that you know the name of. They're giant, they're multi-billion-dollar firms, but they want to sell anywhere from 10 to 20% stake in their business so they can continue to grow. And so these generate great yields typically because you're getting a piece, your part, your pro rata share of the management fees, the carried interest, all the returns that these these private equity firms are benefiting from, you are participating alongside them as if you were shoulder to shoulder in the boardroom, one of the partners. So this can be a unique asset class that can diversify your total portfolio. So 6 to 10% yield range can be common, and you have higher total return potential here than some other asset classes because this is a little under the radar still. Not many people have GP stakes investments in their portfolio, and private equity is a very good business model because they're leveraging other people's money. They're leveraging bank loans to go out and buy assets, improving them, and then taking usually 20% of the total profits that they are making for their investors, which is a very attractive business model. And so this is a way to participate alongside them and invest in that space in a diversified way. Private credit, this is just loans. You just get to be the bank. Being the bank tends to be a good business. You are making loans just as if you were the bank, and you are collecting the interest and principal payments. And here, the interest payments can be upwards of 8 to 11% when you're making a private loan to a business. So you might invest in a fund that has over 5,000 different loans made to American businesses across industry asset classes and sectors, so it's diversified, and then you are benefiting from those recurring debt payments that are made. Typically over 5 years is a common term for these loans. And the reason this opportunity exists is because after the financial crisis, the government really started to regulate banks and required them to hold more capital, made regulations on how they were lending, what type of businesses they could lend to, how quickly they could do that. They made it so cumbersome that the banks actually had to pull back from the lending market. So companies still need debt to go ahead and run their businesses and grow their businesses. And so the private market investment firms came in to fill that gap, and it is a huge gap. So the ranges in yields here are typically 8 to 11%. They are floating in nature, which just means that the interest rate fluctuates with the base rate. And that's a nice feature because it gives you a layer of inflation protection. If we have another spike in inflation like we did post-COVID, then the interest rates on these loans will go up, and you will benefit from higher returns on your interest payments that you're collecting, which is a way to offset the inflation that you're seeing in your daily lifestyle. Bonds and fixed income, just about everybody knows what this is. This is loans from the government. This is United States Treasuries. So these are the lowest risk. This is the closest thing to risk-free that you're ever going to get. This is what the market defines as risk-free. Is it risk-free if inflation is increasing at 2, 3, 4, 5+% in those periods of time? No, because as we saw in 2022, bond prices tanked as interest rates had to be increased by the Fed to combat inflation. And so the market was down some 20% in bonds, which is a giant bummer if you are investing in something that you think is incredibly safe. And to see that principal decline by that much in that particular year was fairly stressful. Infrastructure. This is becoming a very popular word and asset class. It's been around forever. Think bridges, airports, toll roads. Now the focus is really on AI infrastructure, aka data centers, and power infrastructure, the grid, and even renewable infrastructure, solar. And historically, infrastructure has generated predictable returns. As you can imagine, the number of groups that can actually pull off these large projects, there's very few people that can do that. That keeps pricing reasonable. That keeps returns fairly high because there's not infinite competition. So the range of returns has been quite attractive in infrastructure over the years, and it typically comes with a fairly decent yield alongside those total returns. And so this is a space to watch. This is a space that I think investors are going to be allocating to more and more over time. Most investors have 0% allocation to infrastructure, and yet it's going to be a giant part of America's growth story over the next 20 years as we're building out better digital infrastructure for artificial intelligence. Okay, that's great, Brad, but what does this mean for my portfolio, and how do I generate a fair amount of this truly passive income that you're talking about? Well, here's just some math on, hey, if you were going to make some of these investments, what does the return stream look like possibly? Of course, nothing is guaranteed. This is education only. But if you were trying to achieve a $10,000 a month truly passive income stream from these type of investments, what might that look like? And so on the right here, we have the breakdown of that portfolio from private credit down to real estate equity, your allocation on the right, what that pie chart might look like. And of course, we would still recommend you own stocks, but just focusing on your higher income investment portfolio, this is what that allocation might look like. And then you get to this blended yield of around 8%, which is obviously substantially higher than what most people are used to from truly passive income, dividend yields, or United States Treasury yields, which for this math example, we're going to put at 4%. So at 4%, you need a $3 million portfolio to generate $10,000 a month, earn $20,000 a year in truly passive income. Decent chunk of change. At 6%, right? I think we can see where we're going here. You need less money. And of course, at 8%, you need half of that money. So 1.5 million at 8% to generate 10,000 a month in truly passive income. And we've highlighted the 8% because most people need to be careful when you start seeing a diversified portfolio of investments that can generate low, mid teens returns. You tend to be taking too much risk here. It's a yellow flag. It's not necessarily a red flag, but it's something to keep your eye on. If somebody's saying, oh, we can get you 15, 20% type of income returns, well, that's an equity type of risk profile. So it's highly likely they're taking more risk than you are probably comfortable for this portion of your investment portfolio. An income allocation should be lower risk than your growth stocks, than your growth equity side of your portfolio. Therefore, you want this to be more your reliable allocation. Debt tends to be great for that. It's lower in the capital stack. It's got a lot of cushion. A lot of things have to go wrong with that property or that loan to a company, that investment. The equity can get totally wiped out and your debt is still at 100% par value. So debt investments are typically quite good for the income side of your portfolio. The nice thing about this concept is this $10,000 a month is what's coming to you without selling principal. Whereas a lot of advisors want you to sell 4% of your stocks or your retirement in order to pay for your lifestyle. The nice thing about income investments, especially those that are debt and are generating fairly substantial income streams, that is just you benefiting from your investments without touching the principal. And ideally, your principal continues to increase over time, which is my favorite way to actually think about my investments is I want the principal to continue to grow indefinitely, and I want the family to live off the income from those investments, those productive assets. I think that's just a much better way to structure your lifestyle, your investment portfolio returns. You don't have to worry about when you're selling. You don't have to worry as much about the stock market tanking in a particular year and whether or not you should take that vacation or sell as much because the stocks are down. I think that's a depressing concept. This is a way to set your investments and your lifestyle a bit on cruise control. Of course, you got to monitor the investments, but the idea that the money comes in regardless of what you're actually doing and the attention that you're paying to it is the true definition of passive income. And so hopefully this was useful for you. And so if you like this presentation, there's some resources down below. Thanks for watching.